Greetings everyone, welcome to my channel Inside Accountancy by Ch-1, Accounting Made Easy. Thank you to all my lovely subscribers for all your love and support. Your awesome comments, they really make me push myself to create more and more content for you. To all the new subscribers, I welcome to you all for coming to my channel and watching this video. I hope it really helps you. So moving on, today in this video, we'll be talking about accounting for share capital, which is the first chapter from volume 2 in T.S. Kariwal. So we'll be talking about this chapter, and the contents of this video would be, we'll be talking about the meaning and characteristics of company, the meaning and classification of shares and share capital, and the disclosure of share capital in the balance sheet, which is very, very important, and maximum students, they get confused in this particular topic. So if you're watching this video, I think all your theoretical portion would be covered, majority of it. Okay, so let's first talk about what a company is, right? So company, as you normally call it as a joint stock company, which you have studied about in class 11th, is basically an association of persons which are formed and are registered under the Companies Act. Okay, so according to the definition which is given by the Companies Act 2013, we'll be talking about another detailed definition, but according to the definition given by the Companies Act 2013, as per section 2, subsection 20, a company means a company which is incorporated under this particular act or any other previous company law. Okay, so that is the basic definition that is given by the Companies Act, that any company which is incorporated, which started under this act or any other previous company law, is known as a company. But in general layman terms, we can say that a company means when few people, they come together, they form a company and they get it registered under the respective Companies Act, and it is created out of law and it is effected by the process of law. So a company is a legal person, although it does not have a physical existence, but it has a separate legal entity. It is an artificial person which is separate from its members. Who are the members of a company? The shareholders. Company normally has share capital which is divided into shares. We'll be talking about that later. Let us talk about the definition of company in the words of Professor Haney, which is a very elaborate definition in terms of the characteristics. All the characteristics of a company are illustrated through this definition given by Professor Haney, which is a company is an artificial person. It is an artificial person created by law, having separate entity with a perpetual succession and a common seal. So that is a very elaborate definition given by Professor Haney, in which all the characteristics or features of a company can be, seen. So according to this definition, if we look at this, the first point is of the features is incorporation. Now, since company is an artificial person, it is created by the process of law. That is, any company which is registered under the Companies Act, maybe the present Companies Act, that is 2013, or any other previous Companies Act, only that company is said to be a artificial person, a company registered. Okay, then it is created by law having a separate entity. So a company has a separate legal entity. It is an artificial person having a legal entity which is separate from its members or which is separate from its shareholders. The members of a company are known as shareholders. The shareholders have their own legal entity and the company has its own legal entity. So it is an artificial person. Why? Because it can own property, it can enter into contract, it can conduct businesses, it can sue someone, or it can be sued by someone for its debts or for its actions. So that is why we say it is an artificial person, also although does not have a physical existence, but just like a human being can enter into contracts and own property, etc., the same thing can be done by a company. The next feature would be perpetual existence. Perpetual existence means that the existence of the company, it is not affected by the existence of its members or the shareholders. So for example, the death or lunacy or bankruptcy of any member or shareholder would not affect the existence of the company. The company continues to exist. It does not come to an end with the death or lunacy or bankruptcy of any of its members. It comes to an end only by winding up, which is again a process of law. So it is created by law and it comes to an end also through law. Another feature is that limited liability. You must have studied all this in class 11th, that a company, the members of the company, they have limited liability, which is limited to the value of shares that are subscribed for by them. So the amount that they have paid to the company for the subscription of the shares, their liability is limited to that extent. The next is transferability of shares. Now, the shares of a company, they can be easily transferred. They can be transferred except in case of private companies where the shares are non-transferable. Otherwise, the transfer of shares in case of public companies is very much possible. So management and ownership is, obviously you all know that the members of the company or the shareholders, they are the owners of the company. But a company is not managed by all the members. The company is managed by their elected representatives who are called as directors. So the management and ownership are separate in case of a company. It is owned by the shareholders, but it is managed by the board of directors. A company has a common seal. It may or may not have a common seal. If it has a common seal, then it is affixed to all the important documents of the company. So it's just like having a signature. Like we human beings have a signature, a company has a common seal. Okay, so this is all about the meaning of and the features of a company. Now let's talk about quickly about the types of companies. So basically there are three types of companies: one person company, private company, and a public company. Now what is one person company? Now according to section 2 and subsection 62, according to section 2 subsection 62 of the Companies Act 2013, it defines the one person company as a company which has only one person as a member. So the member, the owner, the shareholder, there is only one person who is playing this role. Okay. Now further, only a natural person, okay, a human being who is an Indian citizen and is resident in India can form a one person company, or it can be a nominee for the sole member of one person company. So a human being, a natural person who's an Indian citizen and resident in India may form a one person company. Next is that it should not be formed for a charitable purpose. Okay, it should be carried out for business, for making profits, etc., and it should not be for charitable purposes. It cannot carry non-banking financial investments, the one person company, and the paid up share capital should not be more than 50 lakh. Okay, so the paid up share capital cannot be more than 50 lakh in case of a one person company. The average annual turnover of 3 years should not exceed 2 crores. So these are the various features in case of a one person company, where yes, about the directors also. If we talk about the directors, then at least one director should be there, but not more than 15 directors in case of one person company. Now talking about a private company may have a minimum paid up capital which may be prescribed, and by its articles of association. The companies are not required to have minimum paid up capital at present, according to the notification dated 29th May 2015. But as may be prescribed, that much capital has to be maintained by the company. There is a restriction on the right to transfer the shares, so that in case of a private company, the shares are not transferable. Then the number of members should be 200. Okay, it excludes the present and the past employees of a company, so the number of members can be 200. And if we talk about the invitation to the public to subscribe, it prohibits that. So private company, it prohibits any invitation to public to subscribe for any of the securities in form of shares, investments, etc. of the firm. And if we talk about the directors, at least two directors, and should not have more than 15 directors. And it should always end with the word private limited. If it ends with that, then we say it's a private company. Now in case of a public company, again the minimum paid up capital should be as prescribed. But in case of this the public company, it's basically not a private limited company, which is a definition given by the Companies Act. The number of members should be at least 7. Okay, in contrast to private company where the number of members were 200. And the public company can raise their capital by issue of shares to the public for subscription. They can issue a prospectus inviting the subscriptions from the public. The directors minimum 3, and they should not be more than 15. In contrast to a private company where minimum of 2 directors should be there, and the maximum limit is same for both. The name should end with the word limited, which indicates that it is a public company. So this was about the types of companies. I've just spoken about that in a fast manner because there are more important topics than this. Okay, so talking about share capital. Now, what is share capital? Share capital is the amount that the company receives towards share capital from the issue of shares, which are both equity or preference shares. So share capital is the amount which we receive from the issue of shares, and these shares can be equity or preference. Now, before we understand the term share capital and before we understand what share capital is, I think we should first understand that what do we mean by a share. So what is share? Share is basically a unit in which the capital of the company is divided. So if you can see here from this graph, if this is the capital of the capital of the company is divided into 4 parts, okay, 4 units. These 4 units can be 4 shares. So if the capital of the company is 100, it is divided into 4 shares, and each share has a nominal face value. So one share has a nominal face value of 25. So in all we have 4 shares. So these 4 shares, they comprise the share capital of the company, and each has a face value, and if we add the face value of all the shares, then we get the total share capital, that is rupees 100, as you can see here. Okay, so you must remember that share is nothing but a part of the share capital. It is a unit in the share capital, and it has a nominal or a face value. Each share has a value. The holders of the share, as you very well know, are called as shareholders or the members of the company. Moving on. Now let's talk about the classes or kinds of shares. This also you have studied in the previous class, but we will quickly brush it up. So there are 2 types of shares mainly: preference shares and equity shares. Preference shares are those shares which have preferential rights. They have preferential rights. They have 2 preferential rights rather. One is the right to receive dividend. Now, this dividend is the fixed amount which is calculated at a fixed rate, and it is paid to them before the payment is made to the equity shareholders. So they have a right to receive a fixed rate or amount of dividend before it is paid to equity shareholders. They also have, in contrast to equity shareholders, the dividend may or may not be paid to equity shareholders. So they are the risk bearers. They may either get too high dividend or too low dividend, or sometimes they may not get dividend, because the equity shareholders are the owners of the company. In case of preference shares, they have a right to repayment of capital on the winding up of the company before equity share capitals. Means when the company winds up, their capital is repaid back to them first before making the payment to the equity shareholders, and the equity shareholders, they can get the repayment after the payment has been made to the preference shares. In case of preference shares, they do not have a right to participate in the management of the company. They are not the owners, but the equity shareholders, they very much have the right to participate because they are the owners of the company. Then voting rights, preference shares do not have. They have only in case of special circumstances, but equity shares, they have voting rights in case of all possible circumstances. Preference shares may be converted into equity shares, and it depends upon the terms of issue, but the equity shares, they are non-convertible. They cannot be converted. So now let's talk about the share capital. Let's come back to the share capital. So we have already discussed the meaning of share capital. What is the share capital? The money which is raised by the company by the issue of shares, equity shares and preference shares. That money is called as share capital. Now, if we talk about the classification of share capital, the share capital is divided into 3 categories: authorized capital, issued capital, and subscribed capital. Now let's talk about the authorized capital. What is authorized capital? Authorized capital, or we also call it as nominal capital. So authorized or nominal capital or registered capital. Now you must be wondering, it must be coming to your mind that what is authorized capital? The capital with which the company is registered is known as the authorized capital. It is such capital, it is basically authorized by the memorandum of a company to be the maximum amount of share capital of a company. So the capital with which the company is registered, that is the maximum amount of share capital that it can raise during its lifetime. Now it is stated separately for each class or kind of shares. Like for preference share capital also authorized capital is stated. For equity shares also the authorized capital is stated. So basically maximum amount of share capital under each class or kind of shares which a company can issue for subscription is stated separately. Okay. Now this authorized capital under each class or kind, it may either be more or equal to the issued capital, but it cannot be less than the issued capital. So the capital with which the company is registered, the maximum amount which with which it is registered under the Companies Act and which the company can issue for subscription is known as authorized capital. Now let's come to the issued capital. Now issued capital means such capital as the company issues from time to time for subscription. So basically issued capital is that part of authorized capital which has been offered to the public for subscription. So out of the total registered capital, it depends upon the company how much capital it wants to raise by the issue. So they can either raise full amount or half of it, or as according to their own needs they can issue. So issued capital is that part of authorized capital that has been offered to the public for subscription, which the company has issued for subscription up to the date of balance sheet. Now we'll come to the subscribed capital. Now subscribed capital is that part of issued capital which has been subscribed for by the public. It means that part of the capital which is for the time being subscribed by the members of the company. Okay, so suppose for example if our authorized capital is rupees let's say 10 lakhs. Okay, so let's say 1 lakh shares at the rate of rupees 10 each. That is 10 lakh is my authorized capital. Now it depends upon the company how much shares it wants to issue. Let's say it issues 80,000 shares at the rate of 10 per share. So the issued capital would be 8 lakh. Now if all the 80,000 shares have paid rupees 10, then we can say the subscribed capital is also 8 lakh, and it can be lesser than 8 lakh also depending upon different situations. We'll be studying about that also. So subscribed capital is that part of issued capital which has actually been subscribed by the public. Okay, the money for which has been received. Subscribed capital is further of two types. First is subscribed and fully paid up, and second is subscribed but not fully paid up. We'll be talking about both these cases in the next slide along with certain examples also. Another thing which you must remember regarding share capital is that called up share capital and paid up share capital. These are the two terms which on and off you will be reading about that. So I think it's really very important for you to understand the difference between both. Okay, so the called up share capital. Called up share capital means that share capital which has been called up by the company. So for example, if we say that the company had issued 80,000 shares at the rate of 10 each. So out of 10, the company has only called 8. So 8 rupees per share will be the called up share capital. Okay, and paid up share capital means if the company has called 8 and people have paid 8 per share, so 8 per share would be your paid up share capital. So called up share capital means the share capital that has been called up by the company, and paid up means the amount that has been paid by the shareholders. Now you very well know that share capital is shown under the shareholders funds in the balance sheet. We have already discussed the balance sheet in the previous videos when we were talking about financial statements of a company. There we talked about the format of a balance sheet, and the share capital, as you all know, comes under shareholders funds. So moving on, we'll talk about the subscribed capital in detail because that is where the students get confused. So as I told you, subscribed capital is of two types. First is subscribed and fully paid up, and second is subscribed but not fully paid up. Okay, I've made it under two. Why? Because there are two conditions attached to it, and I'll be explaining each one in detail with the help of an example. So please stay tuned and listen to this what I'm saying very carefully. Okay, so the first is subscribed and fully paid up. Subscribed and fully paid up. The company has called full nominal face value of the shares and the company has received the amount called up. So what does this mean? The company has called up the full nominal face value of the shares. That means if the price, the face value of the share is 10 per share, okay, the company has called full 10 rupees and the company has called 10 and the company has received 10 from each shareholder. So when such a situation happens, then we say it is a part of subscribed and fully paid up. Now let's understand this with the help of an example. Okay, so subscribed and fully paid up. So let's take a problem. Mist Limited, let me just take the pen. Mist Limited has issued 1 lakh equity shares. So how many equity shares? See, the rupees sign is not here. So these are the number of shares that we are talking about. Mist Limited has issued 1 lakh equity shares of 10 each. Registered capital is not given in the question. We are given the information about the issued capital. So 1 lakh equity shares have been issued and the face value of each share is 10. It has called up 10 per share. What does this mean? That the company has called up the full nominal face value, that is 10 rupees, and has received the amount called. The company has also received. It has called up full face value and it has received full face value. So the question is, how will the share capital be shown in the balance sheet of a company? So first of all, let's understand that share capital will be shown in the notes to accounts on share capital under the subscribed capital. Whenever we show share capital is always shown in the balance sheet under shareholders funds under equity and liability part, but in detail it is shown in the notes to accounts. So I'm going to show how notes to accounts will be prepared. So there, since we have called up full value and we have received full value, so that means this is a part of subscribed and fully paid up. The called up value was 10 and the full amount has been received. So subscribed and fully paid up. How will we show it? We had 1 lakh equity shares at the rate of rupees 10. So the total subscribed and fully paid up, the total subscribed capital would be 10 lakh. Now let's have a look how this will be shown in the balance sheet. Before we move on to the balance sheet, I just want to show you the format of balance sheet which has been discussed in the video when I was talking about part B, financial statements of a company. For more details, you can click on the I button and you can watch that video. So as you can see here, the share capital here is shown under shareholders funds under equity and liability. So in case of shares, when we are required to show it in the balance sheet, we will only prepare that part of the balance sheet that is required, that is equity and liability, shareholders funds under that share capital. Okay, I am not putting the amount yet because I need to prepare my notes to accounts. In the notes to accounts, I need to show my authorized capital, issued capital, subscribed capital. Now please remember, this is a particular format which has to be followed. Even though authorized capital was not given in the question, still I have mentioned it and you have to mention it. See, in this question it was not given, so I could have written here dash equity shares at the rate of 10 each. The amount would have been dash here, but I have just taken as an assumption that the issued is equal to subscribed because issue can either be equal to authorized or it can be lesser than that, right? So I've just taken an assumption and I've taken 1 lakh equity shares which was given in the question at the rate of 10. Now this is only for information. The authorized capital has to be shown in the notes to accounts, but it is only for information. This amount is not carried to the balance sheet. Okay. Similarly, issued capital was given 1 lakh equity shares at the rate of 10, that is 10 lakh. Again, this is also only for information. This amount also is not carried to the balance sheet. Both these are only for the purpose of showing that what is the amount of authorized and issued capital. Now we come to the subscribed capital. This is the capital which is shown in the balance sheet. This is the capital which is shown in the balance sheet. So since we had called up the full nominal value 10, and we had received the full nominal value 10. Therefore, it is a part of subscribed and fully paid up. 1 lakh equity shares at the rate of 10 lakh. Now, this is the amount. This is the final amount that we are going to show in our balance sheet. Okay, so this is how you prepare the balance sheet. Okay, so this one is done. Now we move back to our main slide. We were talking about the subscribed capital. We've talked about the subscribed and fully paid up capital. Now let's talk about the subscribed but not fully paid up capital. Now there are two situations here. We'll take one by one. First is when the company has called the full nominal face value of the shares but has not received the amount called up. What does this mean? That if, sorry, just a second. Okay, so what does this mean? If the face value of the share is 10 per share, the company has called full 10 per share but has received, let's say, only 8 per share. So this means this is the first situation where the full nominal face value has been called but it has not been received. The second case is when the company has not called the full nominal face value of the shares. We are not talking about whether we have received or not, but while calling only, if the face value is at the rate of 10 per share, the company has not called the full face value. The company has called only, let's say, 8 per share. We are not talking about receiving it from the people, the shareholders, but the company only has not called the full face value. So these are the two cases which fall under subscribed but not fully paid up. Let's talk about these cases one by one. First, we'll talk about the first case where the company has called the full face value but has not received it. Okay, so let's take a problem here also. Fifth Avenue Limited, a company registered with authorized capital of 1,50,000 equity shares of rupees 10 each issued. So registered capital is given as 1,50,000 shares. Issued 1 lakh equity shares. So registered is 1,50,000 shares and issued is how many? 1 lakh shares. So issued 1 lakh equity shares, it has called the total nominal face value of the share. It has called the total nominal face value of the share. So that means the company has called up full 10 rupees per share and received the amount except, very important, except the final call of 3 on 10,000 shares, equity shares. Okay, so it has not received, the company has not received on 10,000 shares at the rate of rupees 3, which is the final call. Now you must be wondering what is call. So whenever we call shares, if we call up the shares, like let's say the face value of the share is 10. So it depends upon the company whether the company wants to call full 10 rupees together or whether the company wants to break it into different installments. Like there are different stages: application, allotment and call, and there can be first call, second call and so on, right? So this is known as installment method. We'll be talking about this in the next video, and this is known as lump sum method. So for now, understand this is one of the stage of calling up the face value in installments. So the company had called full 10 rupees per share but has not received 3 rupees on 10,000 shares. So how are we going to show it in the balance sheet of the company? Again, share capital is shown under shareholders funds under equity and liability part of the balance sheet, but for that we need to prepare the notes to accounts, and in the notes to accounts, in the subscribed capital, how will you show it? I'm going to just show it to you here and then I'll explain what I have just shown on the screen. So out of the total issued shares, what were the total issued shares? 1 lakh shares were issued. Out of 1 lakh, if we split, only 10,000 shares have not paid rupees 3. Rest 90,000 shares have fully paid all money at the rate of 10. Therefore, 90,000 shares at the rate of 10, 9 lakh has been totally received. So this 9 lakh is a part of subscribed and fully paid up. But out of this 10,000 for which we have not received, 10,000 shares had to pay rupees 10. Total 1 lakh they had to pay. But calls in areas, the amount that is not received on a particular share is known as calls in areas. So 10,000 have not paid 3 rupees. So 30,000 not received. So total 70,000 received. So our subscribed capital would be 9,70,000. Now let's see how this is shown in the balance sheet. As you can see in the balance sheet, we show equity and liability, shareholders funds, share capital. I will not write the amount here because I need to prepare the notes to accounts. I have shown the authorized capital which was given 1,50,000 at the rate of 10, only for information, so double line close. Issued capital was given 1 lakh equity shares at the rate of 10, again only for information, double line close. And then subscribed and fully paid up out of, as I explained previously, out of 1 lakh, 90,000 shares have made the full payment. So 90,000 at the rate of 10, 9 lakh is the amount which will show under fully paid up, and under, see, both categories are shown here, fully paid up also and not fully paid up also, because 10,000 were the people who had made some default. Out of rupees 10, they had only paid rupees 8. They had not paid, sorry, 7. They had not paid 3 per share. So 10,000 had to pay total 1 lakh. 10,000 at the rate of 3 calls in areas. So 70,000 is received. So this is the final amount which will be shown in the balance sheet. The total subscribed capital is shown in the balance sheet. Now we come to the next case, subscribed but not fully paid up, when the company has not called up the full total nominal face value of the share. What does that mean? Does that mean that if the face value of the share is 10 and the company has called up only 8, has not called up the remaining 2, that means it is a part of subscribed but not fully paid up. We'll take another example for that. Noida Toll Road Limited, a company registered with authorized capital of 2 lakh equity shares of 10 each. So authorized or registered or nominal capital is given. Issued 1,50,000 equity shares on which it is yet to make a final call of 2 per share. So what does this mean? Yet to make a final call. That means out of 10, 2 have not been called. So how much has been called? 8 has been called. So how will we show it in the balance sheet? Again, we'll show it under shareholders funds, equity and liability, but we need to prepare the notes to accounts, and in the notes to accounts we'll show it under subscribed but not fully paid up. Why will we show it here? Because of the reason the company has not called up the total nominal value of the share. So it is a part of subscribed but not fully paid up. 1,50,000 were the issued capital. So sorry, shares. So 1,50,000 shares at the rate of 10, but we have called up only 8. So 1,50,000 at the rate of 8, 12 lakh will be our subscribed capital. So how will we show it in the balance sheet? Same, the balance sheet format remains the same. Under notes to accounts, the authorized capital was given 2 lakh equity shares of 10 each, only for information. Issued capital was given 1,50,000 at the rate of 10, only for information. And under subscribed capital, subscribed but not fully paid up. Why not fully paid up? Because the company has not called up total face value or the nominal value. So 1,50,000 shares at the rate of 10, but only rupees 8 called up, that is 12 lakh. Now this is the amount that you will show in the balance sheet. So we have discussed the types of share capital: authorized capital with which the company is registered, issued capital, the capital, that part of authorized capital which has been issued to the public for subscription, and subscribed capital, that part but that has been actually subscribed by the public. Subscribed is of two types: subscribed and fully paid up, subscribed but not fully paid up. I will try to explain it with the help of examples. I hope this all is clear, because disclosure in the balance sheet is a very important topic, and generally a 4-mark question comes relating to disclosure of share capital in the balance sheet. If all these concepts would be clear to you, you will not lose on those 4 marks. So let's recapitulate. We have talked about the company, the meaning, characteristics, the shares, meaning and classification, share capital, meaning and classification, authorized, issued, subscribed, and its disclosure in the balance sheet with the help of certain examples. I hope the concepts are clear to you. If you have any questions, or if you want to say anything to me, suggest me something or ask me something, please email me on my email ID, or you're most welcome to leave a comment in the comment section below. Like, share and subscribe to my channel. It really motivates me. Thank you so much for doing that, those who've already done it. So this is Inside Accountancy by Ch-1 signing off. Thank you so much.